Hello and welcome to episode 202 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leeks. Damien, how are you doing, buddy?
I'm good, Andy. I've had a fantastic week. It's been. I'll come on to it actually because it forms the basis of an entire section of this podcast, and it could take over the whole podcast because I did another. It wasn't a meet-up, but do you remember I talked about a panel event that I went to in London near King's Cross?
Yeah, Tuesday night, was it?
Tuesday night, well remembered, Andy, and it was really good, and I was buzzing for days afterwards. So, yeah, that was fantastic. Good to see. And there were so many podcast listeners that were there. I've not spoken to you since the event, but there were people who listen to our podcast who came along to listen to me talk investing and quiz me and just to meet, which was good fun. I'll come on to that later on. So I'm good, Andy. What about you? You do, I have to say, you look slightly I can see there's like a stress behind that that smile and laugh.
You've picked it up. Actually, it's nothing to do with work. It's actually to do with my private life. For some reason, Damien, and I don't know why. Well, I do know why, but I've agreed to host a dinner party this weekend, a kind of pre-Christmas gathering get-together for 9 adults, and I have to say it's possibly the most stressful thing since we helped to arrange our wedding however many years ago. I don't know what I'm doing in my life, honestly. We've got 9 people coming and I've got to arrange 9 plates, 9 dinner plates, 9 soup bowls and decorations and organising the children.
Is that not the easier part though? It's the food, I'm presuming, that's the tricky part. You actually got to...
The food, we've got menus, yeah. Oh, it's just...
You've got menus?
Stressful.
You're going to do this in your own house, or are you going to like a castle or something?
No, we're doing it in the house, and it's that stressful. I've had to take a day off work this week to get it all organised. It's not good, but anyway,
who are these people, Andy? Because obviously I'm not on the list. Who are they? Who are these people? You roll the red carpet out, the menus. You go and get the posh cups and cutlery.
It's the joys of village life and having friends in the village. And the thing is, we've got the smallest house.
It's a swingers party.
Keys in the bowl at 11 o'clock. No, it's gonna be interesting. So yeah, that's why I've got a slight stress. I'll try not to drift off and think about soup spoons and napkins and the things that I've forgotten. So other than that, I've had a good week. Shall we get on with it? People don't want to hear about my dinner party, or maybe they do. I'll update you next week and tell you what a disaster it was.
You'll have to tell me because you're going to cook, presumably. You're doing some of the cooking, I'm guessing.
I love the cooking, to be honest. I'm not a brilliant socialiser, so yeah, being in the kitchen, being at one with the seared scallops is just where I want to be.
You should have told me the lack of social ability before we did this podcast, Andy, 202 episodes ago. Before we kick on with the first part of the podcast, because we've got obviously the event, what I'm going to do is I'm taking the best bits from that event, the questions that I was asked, and I'm going to pull them together and kind of give you the feeling that you almost were there. So some of the best questions that I was asked on the panel discussion and personally. I'm going to talk about how to know if you need to do a tax return. Lots of people never seem to know whether they need to do a tax return or not. I'm going to tell you how to work that out. Luckily, I remembered we were going to talk about something that I promised we'd talk about in last week's show, which was to do with currencies and investing and Brexit. So I'll do a quick bit on that. And then if we have time, there's some flight booking myths if you're going to go on holiday. So things that if you're going to book flights online, there's some myths surrounding that. But before we get to that, I just want to ask people, if you follow me on social media, you will have seen that we are moving offices. We're expanding. And we're not moving that far. We're actually just moving across the corridor for the same building that we are currently in, but getting bigger premises. And the wall of love, so the wall of all your reviews for the podcast, the website, the book, AG20 Investor, just comments generally about how much you like what we do. We actually decorated our office in it. So if you go on social media and go back through our Instagram profile in particular, you will see the walls of love. There were 2 of them, but unfortunately we've had to destroy the walls of love to put the office back to how it was. So we're going to build new walls of love in the new office, but it gives us a chance to update them, to put new stuff in there. We're getting reviews and comments and emails all the time, but there are people out there who often say, I can't review the podcast because I don't use iTunes, or they don't know where to review it. They may be listening on a different device, or they just want to write some nice things on email. If you want to feature on the Wall of Love, then do send in some glowing comments or leave a review on iTunes, because we're looking at those as well. And you've got a chance of appearing on the Wall of Love. And it's incredibly motivating to us to have that Wall of Love. So there's the admin and not quite a competition, but a chance.
I was going to say, that's almost our first prize giveaway, isn't it? I like that.
The Wall of Love. So yeah, it's brilliant. It is really motivating because it helps us see what people like. And when you're sitting in an office and trying to come up with ideas and things, it's fantastic. So on with the show.
Yeah, so we're going to start off with the main piece today and give people an insight into what it was you were talking about on Tuesday evening in front of some of our listeners, indeed. Yeah, so tell us about it.
Right, the event was based in King's Cross. It was an open invite. I think the panellists were each invited to, or encouraged to try and drum up people to come and watch. And obviously I did. I sent out things on the podcast, newsletters and things. And many of you did come, which was brilliant. Some people I'd never met before who hadn't been to the previous meetup we'd organised a few weeks ago. And the one thing, Andy, I want to say now is it encouraged me even more to do more meetups, because the people who came up to me said, I know I listened to the podcast, love it, etc. These meetups are brilliant. We should do more. Is they going to do maybe more online ones, so maybe webinars, but they particularly want to do more meetups. So we're going to be planning how we're going to do that going forward. We'd like to do them regularly, and even ideas, maybe we get people in a room, give them some beer, and we record a live podcast once in a while, where it's again the Q&A type scenario that I had the other day. One of the funniest things about the event at the beginning is someone come up to me, and I won't name him, and he said that his dad had listened to the podcast for quite some time, and he had just become a financial advisor himself and had listened to bits, and said he loved the show and everything, and he just wanted to see if I was as good live as I was on the podcast. So there was no pressure there before the show that we started. So picture the scene anyway. The panel discussion was 4 people on the panel. I was one of them, with a moderator. And then there was an audience of about 80 people, and then they were allowed to ask us questions. Each person on the panel got to talk about who they were, why they were there, and then we had a breakout sessions where people could come and talk to people individually in like groups. So there was, like, I say individually, it was, you could ask questions individually, but you'd go in a group. So it was a bit of a popularity contest, as it were, which was why I was pleased that so many Money to the Masses people came, because it was brilliant to hear their questions, but it also made me feel good to sit there and think that the reason that you go there and you get to talk to people, there are people actually digging what you're saying.
Definitely.
But what I want to do is go through some of the questions that were asked, because they are very good questions, and people out there who weren't at the event would like to hear them. So I'm going to just start going through them, because there were quite a few. So the event was for people who maybe were beginning investing, had never really invested. Most people had some vague experience, all the way through to people who were clearly keen investors. And the age ranges went from millennials, I hate the term, but people 20s and 30s, right the way up to people who were retired. And so the range of questions was quite interesting. So to kick off, one of the questions that I was asked was really related to people who were trying to build portfolios for the first time, is how do you build or decide upon the asset mix of a portfolio? And anybody who knows me through this podcast knows that I'm a real fan of technology, and I will give you sort of straight answers. Some of the other people maybe on the panel might have given some slightly convoluted answers, but I like the way to cut it straight to it. Now, moneytothemasses.com has a calculator. If you go asset allocation calculator, I've created something on there that you can work out a dummy portfolio. It's not advice, based upon what some of the best passive funds out there do in terms of equity exposure. So you could sit there and work out your equity exposure versus your risk. The way it works is, if you are aged 40, we use the age guide. So if you're aged 40, the aim is you take your age away from 100. That gives you 60. So that means you should have 60% in equities. Therefore, if you use the tool, it will give you a global spread of equities in America, UK, etc. And then some low risk stuff that are bonds, cash, etc. Those are based upon some of the best passive funds out there and how they do it. So it gives you a steer. Aside from that, one of the sneaky ways to do it is go onto the robo-advisors out there. So go and look at the likes of Nutmeg, Money Farm, Wealth Simple, and go and open dummy accounts. And by dummy accounts, you don't put money in, you just go and register, and you do their risk profiling questionnaires, and then actually give you a profile. So you'll find out whether you're a high-risk investor or a low-risk investor or a medium-risk investor, because most people don't know. People always have an overinflated sense of the amount of risk they're willing to take and the size of the losses they could endure during a market blip like the one we've had recently. So this gives them an ability to work out objectively what sort of profile they are.
Just a question on that, Damien. So if someone's doing that and taking the opportunity to fill in that kind of information and they don't have to actually put the money in, do you know if potentially if they're doing a range, say if they're doing it through 2 or 3 different, are they going to broadly come back with the same results from your experience, or will it be different depending on which one you go to, and should they maybe take a mix of all of the results?
What I would do, Andy, which is why it's a good question, is probably do it with a couple of them and get a mixture of the results. The questionnaires are very similar because they've done them on a basis that they want to get through the FCA's scrutiny. So they end up having things like how much cash do you have as a buffer, and they ask you what your previous experience of investing are. Some of them are better than others in terms of demonstrating what risk is and how much you'd be willing to lose, and they some of them are better at actually getting you to think because they use numbers and scenarios, while others will just ask you. So I would suggest, as your question sort of leads to, is maybe do a couple of them and see if you come up broadly with the same profile. Then at that stage they will give you a dummy portfolio. Some of them will actually tell you the ETFs, those trackers that they will invest in, because most of them use trackers, but they are varied. So, for example, Nutmeg has 10 portfolios that are managed, so they're the ones that actually sort of move strategically, whereas someone like Money Farm it's up to 6. So therefore, there isn't a corresponding portfolio, if that makes sense. So their level 6 might be the equivalent of the 10 at Nutmeg, or their mid portfolio might be equivalent of something a little above mid on Nutmeg. So they are slightly different. You can't compare portfolios in terms of just by looking at them. So you go, I'm medium, I'm going in the one in the middle. They don't relate. So what I would suggest is try the different tools, see what the portfolios are, look at the general mix. So how much you've got in America, how much you've got in UK equities, how much you've got in bonds, etc. And then that will give you a feel. And if they all come back and say you're medium risk, then the chances are you are kind of a medium risk kind of guy or woman. And that is what the tools are useful for. You could invest with them, or you can then go and build your own portfolio by going and looking at funds yourself. And how do you choose those funds? That was the next question, of course. You could use something like 80/20 Investor, but you can, of course, use some of the best buy lists you get on the platforms out there. Now, the problem with that is that platforms do, and when I say platforms, I mean things like Hargreaves Lansdown, AJ Bell, Fidelity. Those that have best buy lists, you have to question how the funds got on there. Now, a lot of them say it's down to research. Now, I have no doubt there is that element to it, but there is an element of politics, and there is an element
greasy palms.
It can't be proven. Yeah, there's discounts that have been negotiated on certain funds, and whether they get their palms crossed with silver, or the fact is just they can have been able to negotiate better discounts for their customers, there is an element of that. And off the record, many moons ago, when these sorts of things on certain platforms they were readjusting their best buys, I remember fund houses complaining in the background off record about how the process was being run. And so you just have to be a little bit mindful. This then leads on to another question about fund managers, whether you should buy and hold fund managers for the long term. And these panel discussions and having the audience is brilliant. Like I said at the time, it's just you and I talking, but when you have 80 people, you get some great interaction, so it's brilliant to see people. And one of the things that I pointed out to them, which made them laugh, was that why should you be loyal to a fund manager, maybe like Neil Woodford or any other for that matter, because they don't know who you are, and they don't care who you are, and they are in no ways going to be loyal to you. All they care about is not losing their job. So why would you hang on to a fund that was doing badly because of some misplaced loyalty in some way or belief that they could walk on water? Every fund manager has his day. Every fund manager has his bad day. And when I say him, of course there are female fund managers, but you should review them, because if you review your portfolio Neil Woodford is a good example. If you reviewed your portfolio, you wouldn't have held him since the middle of 2017 because he's done so badly. But there'll be a period where he'll do better again because he tends to have some slightly defensive characteristics to his portfolio. And in times when defensives do better, he will tend to do better. And he's had a little bit of an uptick recently when the markets have wobbled. So don't be loyal to fund managers in any way because they don't care about you. One of the other things that we talked about is passive versus active. So should you favour active funds over passive funds? And I think what people were amazed at, and I was allowed to do this, otherwise I wouldn't have even gone, was the event was run by a fund management company called Janus Investing. So people may have heard of Henderson previously. They ran the event. And so they didn't say that I couldn't say things. I wouldn't have gone if I wasn't allowed to speak freely. And so I was giving honest answers to things like that. So passive versus active, I don't care. There is no right or wrong. It's horses for courses. If you go back, all the research that's been shown to prove that passives outperform active managers over the long term are based on a flawed assumption that you buy and hold a fund forever. That isn't true. Equally, the ones where they prove the opposite, where they sit there and go, yeah, fund managers have done well over this period of time, they cherry pick the time frames. If they say fund managers have outperformed passives over, I don't know, a bear market or something, they cherry pick. So the point is that they all do well in different environments. Now, Vanguard, for example, is a very good passive fund house, and they have some life strategy funds which are incredibly popular. And I was pointing out to people, they've done brilliantly in recent years. And the reason is because they have a large allocation to US equities because of the market cap. It's the biggest stock market in the world, and also they are US based. Then therefore they have a strong currency positioning because it's a fund house that's in America and the assets are largely or skewed towards the US. When the pound plummets against the dollar, they get a big kicker. And of course, what the themes that have happened over the last 2 to 3 years: Brexit, the pound has collapsed. What's the best asset class in the world to be in? US equities. So it's like the perfect storm. What's going to happen on the flip side if for some reason the pound rallied? Let's just pretend for a second, Andy, we had some Brexit wonderland and everything was fine and the pound rallied and actually the stock market collapsed. Generally, it actually went over the edge and US equities did badly and underperformed. Then that would be dire for Vanguard strategies. And there has been periods in the past where they have underperformed. So it's horses for courses. So the way you look at it is you have to research the funds, look at what you're going to invest in. Don't worry whether it's passive or active. You can work that out later. You actually just work out you are invested in passive strategies. I've held them in my portfolio. IPOs was an interesting question that I was asked. Initial public offerings. So that's when a company will decide they're going to float. Right. And what happened, someone asked me and said, oh, you know when you get these things in the post from these platforms? And so Hargreaves Lansdown is one of the biggest. And they go, so what's your decision process of what to do with these? And I said, look, I can talk you through it. It's basically a binary choice between the recycle bin and the dustbin, because which
I love that. I haven't heard anyone have that sort of reaction to IPOs before.
And
good.
And it was good fun, the event, especially when you have somebody on the panel like me who will speak their mind, and people were really good fun as well. It was very relaxed. People were drinking. Even I was drinking on the panel. It's always interesting. But the reason I say that is because IPOs are wonderful things. If the stars have aligned, if there's a company out there you thought, God, I wish I could invest in Royal Mail. They've got a wonderful balance sheet, they're a fantastic company, and all this sort of stuff. And somehow you had the ability to invest in them via an IPO. And the stars aligned and you could get in there early, then wonderful. But you've done all the research. But that doesn't generally happen. The thing is, why people get interested in them is because they suddenly think that there's cases where the share prices jump within the first 24 hours or so, because of the sort of interest and demand, and then they sell. Well, you're speculating. You might as well just pick Bitcoin rather than the Royal Mail. But the reason why the platforms send you this stuff is not because they necessarily think it's a good idea. It's definitely not because they're suggesting it's a good idea for you. It's because they make so much money as a broker if you do it. And if you don't believe me, go and look at the brokers' accounts in the last few years. Go back to, I think it was 2016, when Royal Mail had their IPO. Go and have a look at how much the profits from that boosted their profit levels and profitability. And that's why they do it. And that's fine, but you have to realise you're just getting flyers through the post. So just because you invest with a platform, it's okay to get the stuff they send through and chuck it in the bin. Investment trust. I was asked, why don't I invest in, or do I invest in unit trust, investment trusts and ETFs? Now, they all have their various merits. And there was one chap there who was banging on, investment trusts are the way forward. And why don't you do that? And I said, look, when I invest, I do it with unit trust because it's the most popular type of fund out there due to legacy reasons. Now, there are platforms that give you access to investment trust, unit trust and ETFs and direct shares, of course. But if most people who have products have some of the legacy ones where they can only have unit trusts, it wouldn't be much cop me saying, here's a portfolio that I'm doing and running 50 grand if there was no way that they could even look at it and perhaps take some insight from it so they might be able to apply it themselves. It would be, I think it's slightly disingenuous. It's a bit like you saying to somebody, look how fast I can drive, when you're driving a Ferrari and they're still bombing around in a Reliant Robin. And so I need to be able to do the same as them to show that it's got any merit in what I'm trying to do with things like 80-20 Investor. But one of the things on investment trusts, which I don't think people appreciated, is that investment trusts use a lot of leverage. So they actually have more ability to borrow money to invest and therefore boost returns, but therefore they also can enhance losses. So there's that element of leveraging that you need to look at. And of course there are premiums and discounts. So when you get a unit trust, you get the price of the fund, ignoring bid offer spreads, you always get the price. Well, what happens is with investment trusts, because the way they work, they're essentially a company that all it does is invest in shares. So that's what the investment trust is, and that's why they operate like shares. Well, the underlying value of the things they hold can be worth more or less than the sum of their own shares. So let's say me and you create a company, Andy, and all it did was buy shares in other companies. That's kind of like an investment trust, but you could have the idea that people would sit there and go, I don't really want to hold shares in Andy and Damien's wonky investment company, despite the fact that the shares that we hold in all these wonderful companies are worth way more than what the shares in our company are, if that makes sense, the assets. And that's what a premium and discount. And so you have to bear that in mind. You can suddenly get those premiums and discounts changing quickly, and it may actually be a sign that you might not want to invest in something if the premium's really large. You need to understand it. So although they don't have they're much more fluid, you can trade them daily during the day, unlike unit trusts. There are other things you need to look at. The reason why investment trusts also weren't very popular is because they didn't pay commission. So when when financial advisors used to be able to take so much commission out of you through funds, they weren't able to do it via investment trusts. They'd only do it via unit trusts. And of course, there's still people taking money that way, but it means that they can take a slug. The rules have changed slightly because of RDR. We won't get into that now, but it's a legacy reason. That's why if you are listening to this and you sit there and go, yeah, do you know what? I've never had a portfolio of investment trusts for my IFA or ETFs. Then that was because they probably were getting paid commission and they could take it from the funds themselves without having to explicitly charge you. Those rules have changed now and the fees are much more transparent. Selling at a loss. It was one of the most popular questions is, should I sell? When do I know when to sell my funds? And how long do you hold them for if they're losing money and such and such and such? Well, I sell funds technically at a loss, and I've done it, and I do it often because I don't look at the price I buy at. I don't obsess about it. And if you want to be unemotional about investing, if you are looking at an investment you've got and you're reviewing it, if you're trying to work out whether you should sell it, the mindset to go into is look at it and say, with all the information I have today about that investment, about the market, about my attitude to risk, given all that information, would I buy that investment now? And if the answer is yes, stick with it. If the answer is no, then you need to get rid of it. It's being unemotional and objective. So that's why I don't look at the price, because that enables me not to focus on the loss. It just allows me to look at the fact that this is a donkey, it's gone down. And the aim is obviously to get more right than you do wrong. So if I make switches on my portfolio, there often will be funds, I say often, it will be obviously far less often than the ones that go up. That's the aim. There'll be times where I will sell at a loss, and it's only when I go back and look at it and work out, that one did go down at a loss. But don't also bear in mind that people think when it comes to investing, when you invest in the market or you come out the market, you have to do it all at once. We talk about dripping in, so you can set up a regular, say you had £10,000, you could put £1,000 a month every month for 10 months just to buy the funds automatically. Set that up with your platform. That means that if the market slumps, you're buying more funds and more shares for your money each month. So when it recovers, you benefit from what's called pound cost averaging. But equally, if you're deciding to come out of the market, you don't know whether you're selling at a too low a price or you think the price might go up, you can do the opposite. You could sell out in chunks in an unemotional way, so you get the kind of averaging of the prices as you go out. So that's another idea. I had an interesting question about cash, which we actually covered last week, so I won't go on about it, which was what the best things to do with cash. How do you keep your emotions under control? I've mentioned one or two of those things just then in that last question, but one of the others is don't keep checking your portfolio all the time. Now there's research that's gone out there that says that if you check your portfolio every day, there's about 1 in 3 chance it will be down from the previous day. But if you check it less frequently, let's say you checked it every year, it's almost only not less than 1 in 10 chance it will be down.
I think psychologically that's really important, because in other areas of life, I think not checking in regularly is well received. And things like people when they lose weight, they say don't weigh yourself every day, because it's demoralising, because the likelihood is you either won't have lost weight or you could have put a slight amount of weight on. Weigh once a week and you're going to see gradually, you're going to see that improvement. I suppose you can use that analogy with investing too.
I don't know, Andy, I didn't know that they say that.
Yeah, it's a very big thing in the weight loss circles, I can tell you. I'm well versed.
Yeah, you did write a book about it, and obviously as a man with Crohn's who's had 5 meters of intestine taken out, weight loss is not really high on my agenda. It's more about weight gain. But that's really interesting, because there is a fantastic parallel between money and weight and losing weight. And I don't want to veer off topic, but it's something that we'll come back to in the future. But I often say that money should be idiosyncratic. People have very personal journeys and reasons why they do things. But money is very emotional. And it's like people with food and with weight. If you judge someone just because they seem overweight to you, and you sit there and go, that should be easy, eat less and do some exercise, it's not going to be successful. It's probably very unlikely to be successful. And part of the reason is because there's emotional and psychological reasons about the way that person's life and the things that happen to them that have resulted in where they are. It's a journey. You can't just change that overnight. And it's the same with money. And of course, that's why I struggle with the other experts out there who sit there and come up, this is the way you do things. And you don't realise that we're human. And therefore, it's about that small gains, those small changes. Like you said, that small wins on weight loss. It's the same with money. It's the small changes that make the big difference, because it becomes addictive. It becomes self-fulfilling. You then suddenly realise, do you know what? I can do it. And I think there's something we'll come back to, because it is a really good parallel with, I mean, it's not a world that I am, like you say, you're well versed in it, Andy. I'm not, but I see the differences. So people like Joe Wicks, who've been incredibly successful at what they do, and that is part of the reason, because they're not judgmental. And I think we need to be, as money experts, non-judgmental. We need to be. And anyway, I think that's a good analogy there. Is now a good time to invest is another question. I don't have a crystal ball, but again, it's one of those things that if you knew the answer to that, you would be a billionaire. So you have to be unemotional, so you drip into the market if you think the market is likely to fall. If you think it's only going one way, gangbusters going upwards, and you put all your money in on day one. So, I mean, I could go on all day. I mean, the event was about 2 hours long. There were some really good questions, but it does make me think we should be doing more of this ourselves, Andy, and going and do these shows, because people enjoyed it. So,
do you know what? Do you think there's potentially scope for even doing these meetups around the country at some point? Because I always feel a bit sort of bad for those that don't live around the London area. I'm sure there are people that listen all over the UK. Yeah,
definitely. I think that's a big thing we'll do going into 2019. I'd like to do is to go and try and arrange them in places that outside of the southeast. So we actually go to some other cities around the UK to do them, because they are fun. You get to meet each other and us. And funnily enough, Andy, a number of people I think they were slightly disappointed you weren't there. I thought they thought you and I tag along with each other a bit like Ant and Dec. I don't know if they, yeah. So the thing I forgot to do last week, I want to move on to that quickly. Now, this was currencies. We've talked about don't try and play the currency market with Brexit. Some people may wish to. It's quite dicey. But one of the things that people don't realise is that, of course, you could use currency ETFs that bet on the direction of sterling. Some of them are really, really crazy, and they actually are leveraged, so you'll get like twice the movement up or down, depending on which direction the exchange rate goes. But there is an interesting way, which is via global bond funds. Now, there are certain bond funds out there that actually are quasi-currency funds, if you see what I mean. What they do is they invest so much in US treasuries or American bonds of some kind that what you get is the performance of the bond, like a bond fund, so when the bonds go up and down due to supply, demand and performance. But you also get a massive correlation with the currency because those assets are held, those bonds are denominated in dollars. Then anything that goes on is almost overwhelmed sometimes by the exchange rate, converting it back into pounds. And there are a number of them. At the moment, one of them I hold in my 50k portfolio. But if you're interested, look at something called Newton International Bond. Threadneedle also have a bond fund, a dollar bond fund out there. So there are a number of them. The way you find them is go and get a chart for the pound versus the dollar, and then go and get a chart of the portfolio, or the funds rather, that you're looking at, the bond fund, and see how they've performed over the same period. And you should see if a fund is really effectively a bet on the dollar and the pound exchange rate, you'll see it will match it almost in sync. It's just over time, the bond element, what's going on with bond yields, will obviously have a positive or negative influence on the performance, and therefore it deviates away from that currency exchange rate. But in the short term, it's so close. So I throw it out there because there'll be people who might want to have a bet on it, and they might sit there and think, do you know what, I'd like the idea of a relatively safe asset in bonds, but I'd like the exposure to the currency as well, and they could use their low risk end of their portfolio to do that. But of course, when you've got currency exposure, therefore that does ramp it up a bit, or quite a bit actually, because obviously if you were alternative to go, I'm going to do it via a US equity fund, then you've got the volatility of US equities anyway, plus the volatility of the currency, so it's almost doubly amplified.
So it could be doubly amplified both ways as well, I imagine, which is why it's a potentially a shit or bust type scenario.
Yeah, exactly, Andy. And the reason I throw it out there is because people don't realise that. They don't realise that you can look at a fund and use it in a way that's slightly different to what you would think. And there will be plenty of global bond funds that don't work like that. And it's because they're global, like global equity funds, it's whether they have currency hedging going on. And the more assets funds hold, the less likely they are going to have currency hedging in some ways, because it costs them a lot of money to hedge out currency risk. And if they hold currency, let's say they hold assets, in 11 different countries, to hedge out all those different currencies is very difficult, and it costs a lot of money. It's a drag on performance, so fund managers would rather not pay it, and they'd rather just have that currency exposure. So it's an FYI to be aware of currency exposure of any fund you buy, global bond funds especially, but also you can use it if you want to, if you're trying to make a bet on the fact the pound, for example, is going to collapse. Just before we tie the whole show up, Andy, and finish, we're not going to get onto the 5 flights myths, the 5 myths of booking flights. There, I said it.
Easy for you to say.
We'll roll that over to next week.
You're not wanting to do that now because you couldn't actually say it.
It was partly that. Oh yeah, you got me. But we're like a lottery. We're rolling everything over every week at the moment. So we'll roll that one over. I'm just conscious of the time. But there was a really good tool I saw this week I just want to throw out there. If you ever wonder if you need to do a tax return, and people often struggle, they don't know whether they need to do one, and then they found out they should have done one. If you go to the official .gov website, .gov.uk/check-you-need-tax-return, it's a tool that tells you whether you need to complete a self-assessment tax return, and it's only about 4 multiple choice questions. It's anonymous, so there's no information that goes to HMRC that goes, hey, Andy filled it out and he needs to do a tax return. It's anonymous. It's just 4 things. You press a button, and it's largely things like how much you earn, if you earn more than £50,000, because obviously it's related to child benefit and that being reclaimed, and whether you had any dividend income. Very simple questions which you'll know the answer to, and then it will tell you whether you need to do a tax return. And so it's worth doing, because obviously if you do a tax return late, you can get a fine. And we're coming up to that time of year where you're going to need to start thinking about completing tax returns. So do have a look at that tool if you are at all unsure. There, we're done.
Good. If you want to get in touch with Damien, do so in the usual ways. It's at Money to the Masses. That's 2 with the number 2, Money to the Masses. That's Twitter. Or you can email Damien, damien@moneytothemasses.com. Instagram, where are you, Damien?
Instagram, just type in Money to the Masses, the word, so no numbers, and you will find us. And we're doing lots of stuff on there. We're doing live videos and everything. It's going to be fab.
Excellent. So until next time.
Until next time.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.